If you put these two ideas together, the idea that we're seeing a structural repricing of rates and that you still are overweight the U.S. or expecting the U.S. to take the lead later this year, do you think overall equity returns are going to be constrained by this repricing of rates globally?
So we don't think rates are coming down. We think the 10-year yield in the U.S., which has been rallying, is not the story we're going to see going forward. So there's going to be an adjustment. But we think that, there's like deep forces that will reassert themselves. AI, we still are, very bullish on AI being a powerful source of drivers' returns. And as a result, we think it's possible to withstand higher rates, moderate increase in rates, and withstand those for equity. If we get a very significant adjustment in rates, which is not impossible given the uncertainty we're facing, depending on the policies that will be put in place, then it would challenge the view on equities, I guess, for the U.S.
In the United States, yeah. Do you think that the U.S. is going to be the main beneficiary from this AI megatrend that you've been talking about for quite a while? Or do you think that increasingly you and your colleagues are starting to think about China as also being maybe not as much of a beneficiary, but a significant one with some of the advancements that we're seeing currently?
Yeah, I think both are set to benefit from the AI story. I think both China and the U.S., we think this is where it plays out. There's a bit of a Middle East story as well, but it's not a global story. So we think this is more powerful in the U.S. I think the U.S. eventually provide an environment where we're more comfortable with, I guess, on the macro perspective. So the AI story is playing in both places. I think the macro backdrop eventually is more positive in the U.S. That's why the combination of macro and AI favors U.S. over China for us.
It's interesting you mentioned the Middle East. We just had Sheikh Tahnoon down in Washington, and the UAE saying they're going to invest more than $1 trillion in AI. But a lot of that is almost contingent on them being able to get access to these chips. Is that all the leverage the U.S. holds? They have all the power?
I think that's part of it, right? So first of all, it's a story that is very, very high barriers to entry, a massive amount of capex that is needed to be a player in that space, and I think so. You need big firm with big balance sheet. It's possible for other countries with deep pockets to play a role in there, but I do think that the U.S. does have the upper hand on this at this stage.
When you see positive news like that, but then you also see banks coming out and potentially raising their probability of U.S. recession, how do you weigh the two?
Well, I think right now the part we haven't talked about, we've talked about the 6 to 12 month horizon with our view that eventually we get back to a better place. But for now, as I said, the uncertainty is kind of peak level. I don't think I've ever seen so much a range of views on what might happen. The commentary on the outlook is as wide as I've never seen. It's as political as I've never seen it, and as a result, that is holding back people. And the longer it lasts, then I think we don't think a recession is in the card. We think there's a lot of resilience. In fact, I don't think the recession is the biggest risk. I think the biggest risk is long-term decision, infrastructure decision, and so on. That if they're put on hold, we're going to see a lower structural growth rate in the U.S. eventually, and that's a much bigger deal than a recession.
You keep talking about how later this year we'll get to a better place from some sort of policy level or from a certainty level. What does that mean at a time when we keep talking about uncertainty being a feature and not a bug of this administration?
I'll give you one example in the tariff. I think, right now there is a debate, there's uncertainty about what will be the impact of those tariffs for the U.S., for the trading partners. And you can make an argument that it's going to be minimal, it doesn't hurt the U.S. Once the evidence comes in, I think the leverage of this bargaining chip will be waning. And so I think one way or the other, we're going to see a reduction. It's going to be harder to dismiss the damage from tariff. It's going to be harder to just make bold statement about we're going to go with even higher tariffs, and I think you get to see a convergence someplace as a result.
Is that the moment to buy bonds when we actually start to see that, or is there another reason why you just don't believe treasuries are going to play that role this time around?
I think the underlying forces, we don't think inflation is resolved. I think the Fed last week has painted the most optimistic scenario and they've included that in their forecast on the tariffs.
You don't buy it?
I don't buy it. And then I think the fiscal side, we'll need to see, but we have hope of tax extension coming in, so we know this is going to make the deficit wider if that's the only thing happening. The saving is much more uncertain. So I think the fiscal story remains one of deficits and putting pressure on yields.
When you open up the SEP and you look at those forecasts from the Federal Reserve, which piece of that jumped up to you and said, that's aspirational, I don't buy it?
Well, to me, the most revealing part of the SCP and the press conference last week was when asked about whether this is a one-off story, inflation. I think the chairman was very careful to say, well, we don't know for sure. Last time it was. But when he answered a question later about like when they would get concerned about inflation, he said, well, if we were to see inflation appearing in as part of the economy that have nothing to do with tariff, then we would get concerned. That's to me like doubling down on this is a one-off. They see the tariff as being a one-off, and so that definitely stood out for me.